Bloomberg Audio Studios. Podcasts, radio, news.
Welcome to the Merryn Talks Money News Roundup, where we talk about the biggest moves in markets this week and what's driving them. I'm Merryn Somerset Webb, Senior Editor at Bloomberg UK Wealth.
And I'm John Stepek, Senior Reporter and author of the Money Distilled newsletter.
You missed out award-winning.
Oh, yeah. I'll upgrade it next week. That's all right.
Okay, I want to be absolutely sure you get all the credit I know you want every week.
I crave it.
I know. Right, listen, there's a lot to talk about this week, most of which we're not going to talk about. But let's talk about this interview with Andy Burnham, who may or may not one day be Prime Minister of the UK. And he talked about all sorts of things in it. But there are a couple of things that you and I picked up and thought,
Yeah, so this is his big interview in the New Statesman, which for those listening outside the UK is a kind of slightly left-leaning UK political magazine. So they get Andy Burnham on the cover, and Andy Burnham's currently the Mayor of Manchester, but he's hoping to be the leader of the Labour Party and therefore the Prime Minister. I'm not at all interested in his exact route to getting there because it's the usual political stuff. But one thing jumped out in this otherwise very softball interview, which is at one point he says, we've got to get beyond this thing of being in hock to the bond markets. That just leapt out at me because the most obvious way to get out of hock to the bond markets, in other words, to not owe the bond markets money, is to stop spending as much money and to live within our means. But elsewhere in the article, all he talks about is how he's going to nationalise basically everything. And that would cost money. So I'm just trying to put two and two together to make his sums add up. And what I'm really coming up with is this would be even worse for the public finances than the current situation we're in, which at least it has Rachel Reeves grappling with the notion that the bond market matters and that fiscal discipline matters, even if I don't think she's going about that the right way.
Yeah, I mean, it's an interesting one, isn't it? Because that very comment, we've got to get out of this idea that we are in hock to or controlled by the bond market. It's not an idea. It's not an idea.
Aye. Yeah.
It's a reality. You can't think yourself out of being controlled by the bond market. Or if your debt levels are too high, you are controlled by the bond market. That's just the way it works. And as you say, the only way out of that is to get that debt down, or at the very least, get that deficit down so that the markets trust you. Now, we're not going to go on about this at length, although we could, or we really could, because we've got a podcast coming on this on Monday that I strongly recommend you all listen to it. It's a little bit scary, so nice cup of tea before you start, but do listen on Monday. It's a very interesting perspective on where the UK might be going next, financially at least.
God, that sounds great.
Oh, it is great. I mean, scary, but great. And also politics. There's a little bit of Andy in there, Andy Burnham, not him in particular, but how we might get to the point where there might be an opportunity for him to show us more of his wares.
No, we definitely can't wait now.
Oh, goody. Right. So while we're on the matter of crisis, what I want to talk about today, or what I want to tell you about a little bit, is a note that's just come out from Gavekal Research, and it's a piece written by Charles Gavin. It's called A Turkish Portfolio for France. And he hasn't put in brackets, but he could put in brackets and everywhere else. So what we want to ask is, what is a Turkish portfolio? Sounds like a euphemism, and actually kind of is.
Okay.
What Charles says is that in any country, when you invest, you effectively have a choice between four domestic asset classes. You can invest in shares, you can invest in gold, you can invest in bonds, or you can invest in cash. So we're going to put all the Bitcoin lot and all that aside for one moment. Let's just stick with trad. You've got those four things. Now, if the local currency is worthless or heading in that direction, i.e. you expect very high inflation or huge political instability or whatever it is, then bonds and cash, they don't have any real value in that currency. And if that is the case, if your government is following a policy that structurally debases the value of the national currency, I mean, I don't know who that could be who might be doing that, but let's say your government is following that kind of policy, then you can't possibly diversify domestically into bonds and cash. All you can do is hold a portfolio made up of 50% of shares and 50% of gold, which is what he calls a Turkish portfolio. Well, because you could call it an Argentinian portfolio or something like that. And in future, it may be that we call it a French portfolio or even a British portfolio. Perhaps. I don't know. But, the euphemisms might just keep rolling. And one of the reasons that he writes about this is because he says, look at the social democratic model, or perhaps what we might call the kleptocratic model. It is collapsing in France very fast. It's beginning to collapse in the UK. It's heading in the same direction in Germany and in the US, of course. Guns and butter, blah, blah. One of our colleagues, John Authors, has written a great guns and butter opinion piece. Do read that. Have led to a fiscal situation, which Charles says is, quote, making me very nervous indeed. And he says rational investors should therefore adopt Turkish portfolios in France, in the UK, in Germany, and in the US.
Wow, so he doesn't just single out France, he does. Yeah, okay, that's interesting.
Yeah, he goes right for us too.
I like the way you split up the asset classes there, because that's how I split up asset classes. I think if you're thinking about your asset allocation, it's equities, bonds, gold and cash, and all the other bits are subsets of those things.
Yes.
So, I mean, I agree with him on that. And it's also hard to disagree. I mean, really, he's just making a distinction between real assets and financial assets. I know he kind of calls them kind of contractual assets, doesn't he, or something like that.
Yeah.
Obviously, I think I wouldn't be comfortable saying have half your portfolio in gold and half your portfolio in equities. But I do take his point. And I suppose the one thing that I don't know about you, but my sort of contrarian tingle in my brain keeps on saying bonds have got to be a buy again at some point. It's not saying that very strongly, but I can't help but feel that we will reach a crisis point rather than societal collapse. I don't think that's what we'll get. I think we'll get a turning point, much like the end of the 1970s, and at that point it'll probably be a good time to invest in bonds, but we could be quite away from that.
I think, you're not alone there in that, I've spoken to several people recently who are quite bullish on UK gilts, but I find that quite difficult right now. It feels to me like we've got a bit more of this cycle to go through before we hit a point where the current government or the government that replaces it genuinely understands that running the equivalent of a 6, 7, 8% deficit in the UK, which is where we're likely to end up this year if we don't pull ourselves together again. I refer you to Monday's podcast, please listen, is not sustainable. And that something has to change, whether you want it to or not, whether you feel it's kind or moral or not. Yeah. Something still has to change. I feel we're way off that. So I'm still looking at it and going, Turkish portfolio. Yeah, I could do that.
I wish I'd half my portfolio in gold right now. Yeah, that would be lovely. Yeah.
Half in the NASDAQ and half in gold for the last decade. If anyone has done that and is therefore roaringly rich as a result, please do get in touch. Let us know about it and tell you why you decided to do that. It'd be fascinating. But John, that brings us back to the gold price, right?
Yeah.
At what point do you look at this and go, this is overbought? Or do you just look at it and go, well, actually, if everyone's going to get a Turkish portfolio or a French portfolio, whatever we're going to call it these days, there is a long way to go.
Put it this way, in the past gold bull markets, and quite often I've started to think about these things about like what's your gut telling you, and then what was it wrong about last time, because the instinct sort of starts to kick in, and so there's a little bit of nervousness there, but in my mind that kind of historically means there's probably quite a long way to go yet. And also at a macro level, I think the thing that presumably would stop the gold bull market for good would be a return to some sort of fiscal discipline, specifically in the US. I am not 100% ruling that out, because a lot of people have got such bad Trump derangement syndrome that they can't see that anything that he does will ever turn out well. And actually, in many ways, he is actually raising money in unorthodox ways. That said, I do think that he also would like to see inflation running at 3 to 4% for a while. He'd like interest rates to be much lower. So I don't think that fiscal discipline is going to return anytime soon. And while that's the case, and also while other countries want to get out from under the US dollar system, it's hard to see why gold would, turn around and quit, really.
Okay, so John's a gold bull. Everyone's a gold bull.
Yeah, well, that's the problem. It does feel like that too.
You are our resident contrarian. How does that fit? You know, it used to be for the last decade, we've been able to sit there, you and I, and what has effectively been a gold bull market and be contrarians inside a bull market, which is a very unusual position to be in, right?
Yeah.
But that feel is beginning to change. Now everyone's all over gold. You know, I was listening to the radio yesterday morning, I think I said to you the other day, and there it was. Long chat about gold at prime time.
That was Times Low, wasn't it? That wasn't Radio 4.
No, it wasn't Radio 4.
See, look, I honestly, at this point, I'm sort of looking for either an Economist cover, which would be, I think, a first ever. I don't think the Economist has ever had gold on its cover, not in my kind of time of being an adult. Or maybe something like, you know, a programme on the Today programme talking about it or something like that. I mean, also because, I mean, I was looking at the gold mining ETF, and it has doubled in the year to date. And okay, it was undervalued relative to gold for definitely, and it's playing catch up. But at the same time, you're like, anytime an asset doubles in a year and it's not a cryptocurrency, you've got to sit down and start thinking, right, well, how much more exuberance can get into this? And yet at the same time, I don't feel that it's not at kind of, you know, 2011 levels yet, and that we did get kind of cover stories and ATMs dishing out gold and things like that at that point. So I guess that's where I am. But you're right, all of the models that people who are actually quite good at analysing gold have built over the last, you know, 20 odd years all suggest that it's actually really very overvalued. It's not as overvalued as it has been at some points in the past, but it's certainly not cheap.
But then I think you could also say, and we'll finish with this, we could also say that those models do not take account of possible fiscal breakdown, of which there is a non-zero possibility of full fiscal breakdown across much of the West. Very hard to get that into a model. Very hard. When you're looking at a model for the price of gold, you're comparing it to the market cap of stock markets, or you're comparing it to history, you're comparing it to where it moved in this crisis or that crisis or this crisis. But it's very hard to input into your model what happens when the majority of the West has a debt to GDP level of 100 or 100 plus. How did you get that into a model?
It's proper tail risk stuff. And obviously the actual history of gold does not go back that far. You know, it's only been free floating since the 1970s. So I'm not, you know, it's very hard to say, like, well, what would the gold price have actually been during, you know, World War II, which was the last time everyone had debt to GDP ratios at like over 100%.
Yeah, but that didn't count. That didn't count because everyone also had plans to bring that level down by, you know, not being at war anymore, right?
Yes.
Hello, peace dividend. We have nothing like that anymore. There is no plan to bring down the vast cost of the welfare state by not having a welfare state anymore. I mean, that doesn't exist. So we cannot even begin to compare the level of debt we have now with the level of debt that we had post-war. Don't get me started. I mean, as do you remember that the wonderful phrase that Russell Napier was used to use, that, you know, we built up the debt in wartime, that it was built up by killing people. And if you stop killing people, suddenly you don't have to spend so much money. Woohoo. And now we built up our debt by keeping people alive, and we're certainly not going to stop doing that. So where do you go from here?
I mean, I'd quibble with keeping people alive, but that's a different issue.
Anyway, I think we had better end it there, John. Anything else we need to add?
I don't think so. I mean, I think if you're worried about gold, the one thing I would say is just think about what your asset allocation was, where it's at now, settle it down to your asset allocation. But I'll be honest, I'm not rebalancing just now. I'm just saying, if you're nervous, you know, sell down to the sleeping point, as the old Wall Street guys used to say. Okay.
Thank you, John. And we're also pleased to know that you're not selling down. I'm not going to ask you about your Bitcoin account. Thanks for listening to this week's Merryn Talks Money debrief. If you like our show, rate, review, and subscribe wherever you listen to podcasts. And keep sending questions or comments to merrynmoney@bloomberg.net. I hope you enjoyed the pod we did the other day answering your questions. Do send more. You can also follow me and John on Twitter or X. I'm at MerrynSW, and John is John_Stepek. This episode was hosted by me, Merryn Somerset Webb. It was produced by Sam Asadi and Moses Andam.